Joining us here on set this morning, Barclays chief U.S. economist Mark Giannone and Research Affiliates chairman Rob Arnott. Morning, guys. Good to see you both.
How are you?
Rob, how much changed last Tuesday, do you think? Are entire theses being rewritten, or is this a continuation of the things that were already in place to some degree?
Well, I think things changed less than a lot of people would like to believe or would fear may happen. Things are never as good as one hopes or as bad as one fears. And one of the things that we've written about is there's a tendency for stocks to rally in the aftermath of an election, regardless who wins. Why? Very simple. In a contentious election, both sides are terrified that the other side's going to win. And some are terrified enough to take chips off the table and go risk off. Election happens, and one side is, phew, relieved, I'm coming back into the market. The other side, the folks who are scared enough to be out, are already out. So you get net buying. It happened in 2020, it happened in 2016, 2012. Go back for the last 100 years in a contentious election, it happens about 80% of the time. And people are surprised by it.
As for yields, Mark, are they going up for the right reason? Is it about growth, or are there worries about deficits and tariffs and labor force?
So we've revised our forecast for inflation slightly higher next year because of the tariffs, because of also restrictions on immigration. And we are not convinced that growth is actually going to pick up. If anything, we revised our growth forecast down for that. So in light of higher inflation expectations and higher inflation realizing potentially next year, we think that the Fed will not be able to cut quite as much as was expected before. So to some extent, it makes sense to us to see these near-term yields sort of move back up.
You're still looking for a cut in December?
We still have a cut in December. We think this morning's CPI came in right around expectations, so no surprise there. We're still looking for some slowing in inflation in the next month print. We expect a sizable rebound in payroll employment, but we think that the trajectory of payroll gain is actually downward. So with that, we think the Fed will still likely cut at the December meeting.
Why? Why wouldn't they take a pause? Inflation is showing that there's sticky elements of it, particularly in core and in services, and the economy is doing just fine.
That's absolutely true. I mean, we've been on the resiliency sort of view of the economy like for a long time, and I do think that policy is not particularly restrictive at this point. But the Fed sees policy as still quite restrictive, and I think they want to bring the policy rate to a level that they view closer to neutral. So we think that they are going to likely cut again at the December meeting. And after that, I think it's going to be more difficult. We don't expect a cut in January. I think March is still a possibility to the extent that the economy continues to slow and we don't see a pickup in inflation. But I think for the second half of next year, it's going to be very difficult to cut.
But do you see the Trump policies as inflationary and adding to this dilemma?
So, so far, I'm not incorporating anything in our forecast about increasing deficits beyond the renewal or extension of the existing Trump tax cuts from 2017. So we'll have to see what the House, what the Senate, and all that are coming up with new packages on the fiscal side. But the restrictions that they are putting in on immigration and the increase in tariffs that are likely to come, we think are going to be inflationary. The restriction in immigration in particular are going to lead, in our view, to a tighter labor market. It's going to lead to renewed wage pressures. And if anything, is going to bring the unemployment rate down, even if the economy is actually slowing.